Right now, as we look at the live market action, Strive Inc., trading under the ticker ASST on the Nasdaq, is changing hands at exactly $1.08. The stock is currently down 3.55% for the day, shedding 4 cents from the previous close. We are seeing this price action unfold in the morning session, specifically around 9:37 a.m. Eastern Time, and the immediate setup on the chart is telling a very specific, somewhat tense story. The stock opened at $1.07, dipped to a low of $1.05, and managed a brief push to a high of $1.09 before settling back into this current range. When you look at the wrong numbers, a 4-cent move might seem negligible to the uninitiated, but for a stock hovering just above the critical $1 threshold, this represents a significant volatility contraction that often precedes a much larger, more violent move. The market capitalization is sitting around 88 crores, or roughly $10 to $11 million depending on the exact share count updates, placing this squarely in the microcap territory, where logic often takes a back seat to liquidity and momentum. The expectation for a stock like Strive Inc., especially one that has collapsed from a 52-week high of $13.42, is that the company is effectively dead money, a falling knife that has burnt every investor who tried to catch it on the way down. The general consensus, when you see a chart that has gone from over $13 to nearly $1, is that the fundamentals have completely eroded, and the market is simply waiting for the final flush. However, the reality is often far more nuanced and deceptive. When a stock flattens out like this after a 90% decline, it is not always a sign of death. It is sometimes a sign of absorption. The reality here is that the selling pressure, while still present, has shifted from panicked liquidation to a methodical exchange of shares between exhausted retail holders and speculative accumulation algorithms. We are seeing the stock struggle to hold the $1 line, and this is where the psychological warfare of the market is most intense. The expectation is that it will break $1 and drift into penny stock purgatory, but the reality is that maintaining this $1.08 level despite the broader market pressures suggests there is a stubborn bid sitting underneath, likely keeping the price propped up for compliance reasons or strictly technical accumulation. Let's look closer at the intraday movement we are witnessing right now. The stock opened at $1.07, slightly below the previous close of $1.12. This gap down at the open is a bearish signal, indicating that sell orders were stacking up overnight or during pre-market hours. However, the fact that it touched a low of $1.05 and immediately bounced back suggests that there is no massive liquidation happening at this exact moment. Instead, we are seeing a lack of liquidity. In these microcap names, when volume dries up, the bid-ask spread widens, and small sell orders can walk the price down disproportionately. The trading range today is extremely tight, only 4 cents between the high and the low. This compression usually acts like a spring. When volatility collapses this hard, it is mathematically impossible for it to stay this low forever. Energy is building up, and the release of that energy will likely drive the stock violently in one direction. If it breaks the intraday low of $1.05, we could see a rapid test of the 52-week low at 34 cents. Conversely, if volume steps in and pushes it past $1.09, we could see a squeeze back toward $1.20. This brings us to a critical part of the analysis that is often overlooked but is absolutely vital for anyone holding or watching ASST, the short selling dynamic. When a stock falls from $13 to $1, the short trade has been incredibly crowded and incredibly profitable. Bears have made a fortune riding this down. However, at $1.08, the risk-reward ratio for new short positions shifts dramatically. Shorting a stock at $13 offers $12 of profit potential with relatively defined risk. Shorting at $1 offers only $1 of profit potential, but the upside risk, if the stock squeezes back to $2 or $3, is multiple hundreds of percent. You need to be aware of whether this stock is currently under pressure from short sellers trying to drive it into the ground, or if those shorts are starting to cover. Investors need to look for specific data points to understand the short positioning here. You should be checking the borrow fee rates at your broker. If the cost to borrow shares of ASST is spiking, it means shares are becoming hard to locate, which is a classic precursor to a short squeeze. When the supply of lendable shares dries up, existing shorts get nervous. If you see the borrow rate jump from 10% to 50% or higher, that is a flashing warning sign that the trade is getting crowded. Furthermore, keep an eye on the failure to deliver, or FTD, data. In stocks that have been beaten down this badly, you often see a spike in FTDs, which happens when short sellers execute trades but fail to deliver the underlying shares within the required settlement time. This can sometimes signal naked shorting or simply structural inefficiencies that eventually force mandatory buy-ins. If you see a high number of FTDs accumulating for Strive Inc., it implies that there is artificial selling pressure that must eventually be resolved by buying shares on the open market. It is also worth noting that in the digital landscape, retail investors are becoming much sharper at spotting these setups. There is significant chatter on forums and social media platforms regarding tickers like ASST, where traders are debating whether the bottom is in. The argument usually centers on whether the company has enough cash runway to survive without further dilution. Dilution is the enemy of the shareholder in this scenario. If Strive Inc. needs to raise capital to keep the lights on, they will likely issue new shares, which increases the supply and drops the price further. This is likely why the stock is struggling to break out of this downtrend. The market is pricing in the fear of an offering. However, if the company releases news stating they have secured financing or have cut costs enough to reach profitability, that fear evaporates and the stock re-rates instantly. Before we go further, I want to pause and ask you directly. Comment below how many shares of Strive Inc. you currently hold, or if you are looking to enter at these levels. Are you sitting on a high average cost from the $3 or $4 range, hoping for a recovery? Or are you a new buyer snipping this at $1? And also, what is your take on the rising short interest? Do you think the smart money is right to bet against it? Or is this blatant manipulation? I want to see your thoughts in the comment section, because the sentiment around this stock is incredibly polarized. Now, let's pivot to the business itself and the fundamental backdrop. Strive Inc. and companies in this asset management or digital asset space face a unique set of challenges in the current macroeconomic environment. With interest rates remaining relatively high compared to the last decade, the cost of capital is expensive. For a company with a market cap of 88 crores, accessing cheap debt is almost impossible. This means they have to rely on equity financing or operational cash flow. The massive drop in the share price tells us that the market does not believe the operational cash flow is sufficient. The business model, likely centered around asset accumulation, audience monetization, or digital services, relies heavily on trust and scale. When a stock price collapses, it can actually hurt the business operations because it erodes confidence among partners and clients. It becomes a self-fulfilling prophecy. To break this cycle, the company needs a catalyst, a major partnership, a buyout rumor, or a quarterly report that blows expectations out of the water. We must also discuss the technical support levels on a longer time frame. The 52-week low is 34 cents. That is the floor. If the current support at $1 fails, there is virtually no technical friction between here and 34 cents. This is what we call an air pocket. Stocks tend to fall through these air pockets very quickly because there are no historical buyers at 80 cents or 60 cents to step in and defend the price. However, the fact that the stock is holding above $1 is significant because of the NASDAQ listing requirements. To remain listed on the NASDAQ, a company generally needs to maintain a minimum bid price of $1. If ASST spends 30 consecutive business days below $1, they will receive a deficiency notice from the exchange. This starts a clock, usually 180 days, for them to regain compliance. This is a double-edged sword. On one hand, it creates pressure on the management to artificially prop up the stock, potentially through a reverse stock split. On the other hand, it forces them to take action. Investors should be very wary of a potential reverse split. If a company announces a 1 for 10 or 1 for 20 reverse split to get the price back to $5 or $10,
it is often viewed negatively by the market, and the stock tends to sell off post-split. Let's zoom out and look at the volume profile. In the image, the stock is showing a decline, and while we don't see the exact volume bars, the tightness of the price action usually implies low volume. Low volume on a down day is somewhat constructive. It means people aren't rushing for the exits, they're just drifting. But low volume on an up day is concerning because it means there is no conviction behind the buying. For ASST to reverse this trend, we need to see a volume tower, a day where the volume is 3 or 4 times the average daily turnover, accompanied by a price increase. That signifies institutional interest. Until you see that, any movement is likely just retail noise or algorithmic churning. The sector momentum is another factor to consider. Financials and asset management firms have been under scrutiny, and microcaps in this sector are often used